Hey guys, welcome back. Today we are going to talk about an old but rather useful indicator for trading, the Bollinger Bands. So in this video we will be talking about number one, what are Bollinger Bands? Because we need to actually know about the indicator before using it for trading. And number two, how Bollinger Bands are related with prices. So we all know that price is supreme and all indicators are derived from prices. So if we understand the relation of an indicator with a price, then we can understand the nature of an indicator, because there are different types of indicators available. There are trend indicators, there are momentum indicators, there are volatility indicators. So if we understand this relation, we can understand the nature of an indicator. And finally, we will talk about 5 strategies with Bollinger Bands that we can use for trading, of which I will talk about some of my personal favorites. So let's get started right away without wasting any time. And if you find this video useful, kindly like this video and consider subscribing to this channel. Bollinger Bands are actually volatility indicators. So if you don't know about volatility, in simple words, it is the speed or actually the degree of change in prices in either the upward or the downward direction. So the thing is, when volatility increases, the potential to make money increases because the market makes big moves very quickly. On the downside, there is a higher risk involved with higher volatility. On the other hand, when volatility decreases, the potential to make money decreases because the market is actually in an accumulation or consolidation phase where the market is not actually doing anything. So the Bollinger Bands is made up of actually 3 lines, or in fact 3 bands to be precise. So there is an upper band, a middle band and a lower band. The middle band is the 20 period simple moving average. The upper and lower bands are 2 standard deviations away from the middle band. So if you don't know about standard deviation, simply put, standard deviation is a statistical concept. So it describes the variation of prices around an average value or an average price. Let's say, for example, the average or mean value is 50 rupees and the standard deviation is 10 rupees. Then for the first standard deviation, the upper band will be 60 rupees and lower band will be 40 rupees. And for the second standard deviation, upper band will be 70 rupees, lower band will be 30 rupees. So actually we are predicting the future prices with Bollinger Bands. Now the question arises, why are we using 2 standard deviation? Why can't we use 3 standard deviation or even 1 standard deviation? It is possible to use 3 or 1 standard deviations. The idea of using 2 standard deviation comes from a concept of normal distribution curves. So by using 2 standard deviation, we are actually capturing 95% probability that the price will fall between the upper and lower band. So consider if we are taking only 1 standard deviation, we will only get 67 or 68% probability. While if we take 3 standard deviations, then we can capture up to 99% probability. But standard, we will use 2 standard deviation in most of the cases. So basically, standard deviation measures how far you are away from the average. Now we can come up with a few conclusions. If price is near the upper Bollinger Band, it is considered to be expensive because it is 2 standard deviations above the average, that is 20 moving average. And if the price is near the lower Bollinger Band, it is considered as cheap because it is 2 standard deviation below the moving average. So in short, Bollinger Bands serves 2 purposes. Number 1, it identifies potential overbought and oversold areas. And number 2 is that it identifies the volatility in the markets. The first method or strategy that we will be discussing is trading the trend with Bollinger Bands. As traders, we always look to take winning trades, right? And that is why we focus more on areas of value. By areas of value, what I mean is that these are areas where some price action is expected. The areas of values can be anything from supports, resistance, dynamic zones, trend lines, and even moving averages. So here in Bollinger Bands, we use 20 SMA or 20 simple moving average as default. And in trending markets, which means either bullish or bearish markets, but trending in nature, the 20 period moving average can act as an area of value. So there is a potential to take a trade What this means that when price moves back or pull back to the 20 moving average, it gives a trader an opportunity to go long or short. Just because price pull back to the 20 moving average doesn't mean you can take a trade every time it does that. We have to look for confirmations before taking a trade. By confirmations, what I mean that look for strong price action candles like bullish engulfing candle or bearish engulfing candle, pin bars, both bullish and bearish pin bars from the moving average. We have discussed that Bollinger Bands provides a relative definition of high and low, which means it provides a definition of expensive and cheap. So the upper band is considered to be expensive and the lower band is considered to be cheap. For example, if the price moves near the upper band or even break through the upper band, many traders think that the security is being overbought or is expensive at this moment. So what this does is that many traders start selling and there might be chances of a strong selling pressure towards the mean value. The opposite is also true. That is, when the price moves near the lower band or even break through the lower band, the security may be seen as oversold. So many traders will start buying the stock and thus it can reverse back to the mean value or even to the upper band. This is one of my favorite ways of using Bollinger Bands, that is using volatility. I have mentioned earlier that when volatility decreases, the price action also decreases, which means the prices start to accumulate near the mean area. And so the Bollinger Band size contracts. And at some point, the price just breaks out of this contraction or accumulation phase. And this is when the Bollinger Band expansion happens. And this is when you get large price action or high volatility moves. So this is where you can actually make large amount of money. The stock moves with huge momentum in the upward or downward direction. The volatility contraction and expansion happens in cycles, which means there are typically times with low volatility where the prices are sideways, which is known as contraction. And after contraction, there will be a period of expansion, which is characterized by huge volatility and big price movements. The fourth method takes into consideration two areas of interest or areas of values. We have talked about the expansion phase of Bollinger Bands. That is when the price makes huge moves and moves away from the middle band or the 20 period moving average. Now, whenever the price goes too far away from the moving average, it tends to come back towards the middle band at some point of time. It is this idea that we are going to trade. For this, we require a support or resistance or even a dynamic zone and, of course, Bollinger Bands. Now, during an expansion phase, price moves with a huge momentum into a support or a resistance, and the candle closes above or below the upper or lower band, which means the market is overvalued. In case of a support, if the next candle is a bullish reversal pattern like a pin bar or a bullish engulfing candle, then the market is likely to reverse higher. And for a resistance region, if the candle formed is a bearish reversal pattern like a pin bar or a bearish engulfing candle, then the market is likely to reverse lower towards the mean region. So coming to the last and final strategy, this is another personal favorite of mine. It is a combination of two indicators like Bollinger Bands and RSI. The Bollinger Band is a great indicator. It can be used to identify the areas of values, overbought, oversold regions, and also the volatility in the market. But the problem is that it does not tell you the strength or weakness of a particular move. For example, if the price is trading outside the upper bands, Bollinger Bands will not tell us the price is going to move higher or just come back to the mean value. So this is where RSI or Relative Strength Index comes into play. So what we are looking at is the divergence of RSI. If you don't know about RSI divergence, I will give a brief description because I will make a separate video on RSI and RSI divergence. Now listen to me very carefully. Number one is bearish divergence. So this happens when the market or the price makes a higher high, but the RSI indicator shows a lower high, which is actually a sign of weakness and the market is expected to move down. Now the second type is bullish divergence, which means the market or the price makes a lower low, but the RSI indicator makes a higher low. This shows a sign of strength and the market is expected to move higher. So this is RSI divergence in brief. So now combining RSI divergence with Bollinger Bands. If the price is at the upper Bollinger Bands and the RSI shows a bearish divergence, this indicates a weakness in the market, which means that the price can move down to the mean or the moving average. Now on the other hand, now if the price is trading at the lower Bollinger Bands and when you look at the RSI, it shows a bullish divergence. This indicates a strength in the market and the price is expected to move higher and you can always take a long entry.